Hi team, in this video I want to explain why private equity is increasingly relevant to you, and why it would behoove you to learn more about it. To start, private equity is a flourishing industry that has scaled at a fantastic pace, and grown ever more powerful largely outside of the public eye. The business revolves around the simple premise of achieving attractive returns by acquiring assets with a combination of debt and equity, and its continued success has facilitated the growth of this industry from 24 private equity firms in 1980 to roughly 8,000 firms managing billions of dollars around the globe. A report by Ernst & Young claims that private equity is one of the most profound shifts in capital markets since the 19th century. And as the number of firms funded by private equity grows, so does its influence. The Institutional Investor reports that companies backed by private equity employ nearly 9 million people in the United States alone. The industry's increasing relevance is all the more astounding when you compare it to other financial institutions. The Economist reports the number of banks peaked in 1984, mutual funds in 2001, companies in 2008, and hedge funds probably in 2015. Today, private equity firms are sitting on top of a mountain of dry powder, and it is anticipated that this growth will persist as it becomes increasingly available to a broader class of investor via 401k, retirement plans, and lower thresholds for investor participation. As such, private equity requires your attention. An easy metric to evaluate how this industry has scaled is the amount of dry powder waiting to be deployed. Dry powder represents the amount of capital available for investment, and the amount of private equity dry powder has been on the rise since 2012, hitting a record high of $2.5 trillion in December of 2019. This peak represents a 5 times multiple on the sum available in 2003, and more than half of all available dry powder sits in North America. Now, naturally, if you're watching this video, you may be most interested in a job in private equity. If you enjoy the work, it can be a terrific and lucrative career. But beyond the compensation available to private equity professionals, there are increasingly reasons that individuals will be exposed to this asset class regardless of their employment. The first is that private equity funds are entering the nearly $6 trillion marketplace of 401k workplace retirement plans. The U.S. Department of Labor issued guidance to include private equity funds in certain plans, and private equity funds are already included in traditional pension plans and outperform public stocks. Allowing private equity funds into 401k plans could boost everyday investors' performance while also diversifying their portfolios. The second is newly lowered standards for so-called accredited investors. A recent ruling has opened the door for more investors to have access to the world of private equity, which requires qualifying as an accredited investor. Previously, to qualify as an accredited investor required annual income of at least $200,000 for an individual or a net worth of at least $1 million. These requirements limited the number of people that could participate as an investor in a private equity vehicle. The ruling, however, expands its definition of accredited investors to include people that have an entry-level stockbroker's license, knowledgeable employees of non-public firms, and more. The SEC chairman recently stated that people will be able to participate in the private capital markets not only based on their income or net worth, but also based on established clear measures of financial sophistication. With more investors allowed to participate in private markets, private equity firms will also see the amount of capital committed to the space continue to grow. The SEC estimates $2.7 trillion was raised in private markets last year compared with $1.2 trillion in public markets. This new ruling has the potential to further fuel the growth in the private equity industry while also allowing more investors to grow their wealth. Additionally, it will allow small businesses and startups to more easily raise funds. I also want to add a recent personal anecdote. Not too long ago, a friend of mine approached me to discuss an offer he had received. He had just been offered a 6% equity position in a private equity-backed business with several $100 million of revenue. Superficially, it sounded amazing, and he was excited about it, but he wasn't sure that he understood what it meant, or what that 6% could potentially be worth in the future. He asked my opinion, so I requested some information about recent performance, capital structure, and the certificate of incorporation, and quickly realized that at current levels of profitability, it was unlikely that the business would have any equity value at all. So I put together an Excel schedule demonstrating what he would have to achieve as COO, the title he was offered, before his 6% became meaningful. And the outcome was that the earnings of the business would have to nearly double, which was highly unlikely given the historical performance of the business and the industry, which had a long history of single-digit growth. So ultimately, he decided to decline the offer he was originally excited about, which I say only to highlight that it is important to understand how these structures work, even if you're not working at a private equity firm. Finally, if you are ever in the position of selling a company, how private equity firms evaluate investment opportunities will give you an advantage in the negotiation. Whether as a career, an investor, a 401k participant, or even an employee of a private equity-backed company, As the industry continues to scale, it will be increasingly relevant to a growing corpus of people. And in that light, we hope you will find the information in this course helpful. All right, team. Thanks for watching. That's all for now.